I'm going to show you how to order your first call option today. And so what we're going to do is we're going to go ahead and click on an example of a call option that I have here, the Uber $70 call option. I have 10 contracts. It says 10 buys here, and it expires at 12/20, meaning the date, December 20th, and current price of that option is $4.63, and you can see it's down about 4.5%. So let's go ahead and click on this, and let's kind of see what exactly is going on here. So the market value, current value of the contracts are $4,630. They are set to expire once again around January 20th. The average cost that we paid is $4.80, meaning our total value should have been close to, $4,800, which kind of makes sense with this $170 loss so far, this return. And the current price of Uber sits at $72.57. Now, what is a call option? A call option is essentially you buying a contract stating that you believe, that the value of the stock will go up. And so you're buying a contract based on that with 100 shares per contract. Every contract that you buy is going to have 100 shares per contract. And the way that the money is calculated is that if you make a penny, for example, past your break-even price, and notice here how it says break-even price, if you make a penny past your break-even, that penny is multiplied by the amount of contracts and how many shares, right? So, for example, if I have, let's just say, for example, one contract with one share, right? That penny is going to go up, and it will make me a penny times 100, because it will be times 10 again, right? So it'll be $1. That's how much money I will make in my case, or at least somewhere close to that, maybe $10, $1, whatever. Math is off, but you get my point. You're essentially taking the gap, right, price. So we'll actually pull up a calculator and a whiteboard to figure this out, but I'll kind of explain it here just so that it kind of makes sense and so I don't make mistakes on my math. Let's say our break-even price is 80, and the price now becomes 81. Let's use this as an example, okay? Well, it gapped $1. The dollar, it's a pretty actually large gap, right? And this is assuming that it was our break-even price. This $1 price right now is going to be multiplied by the amount of contracts. So let's say we have one contract. Well, that one contract becomes that $1. So it's $1, but one contract has 100 shares in that one contract. So it's really 100 times the one, and that will then equal to $100 in profit. So made a mistake on my last one. It's probably $10, but you get the point, okay? $100 in profit. So it's essentially the amount of contracts times 100. So, for example, if I have 5 contracts, that would be 5 times 100. And so what makes options relatively dangerous overall for average traders or beginners even, and I'm a beginner, of course, but for beginners, it's relatively dangerous because if the contract expires, right, whatever it expires at is essentially what you're going to have, right? So, for example, if the stock price went down to, let's say, 75, well, that's a $5 loss, and that's 500 shares, for example. Or let's use this case. If it's a $5 loss, we're taking $5, because that's the gap, right, between 80 and 5, so that's 5. I'm going to try to draw a good 5 here. All right, sorry for my handwriting, but 5 times the 100 shares, because there's only one contract, which in this case is $500, right? So essentially, your total would decrease by $500. And what's the total? Well, the total represents how much you have in your portfolio. And usually the price is taken right out of the buying power, okay? So that's pretty crucial to understand. And so essentially, you're paying for these contracts up front. Now, some people like to trade on margin. I really don't recommend that. But the point is it doesn't really matter what I recommend. You do what you want. But the point is that there are different ways to make money, and this is just me simply explaining the options kind of trading. Now, options trading is much different than holding the stock and selling. There is no timeline on holding a stock and selling. I mean, you could hold for a year, you can hold for 10 years, you can hold for a week, you can hold for a minute. It doesn't really make a difference. But with these contracts, they do kind of expire at a certain point. So how do we actually do this? Well, we can click view all options, right? And these are the current options that you can purchase. So let's kind of go through this here. Robinhood makes it relatively easy by clicking on this builder. And you can kind of select. So we have calls, we have puts. Basically, what a call is that you believe the stock value will go up over time. That's why it says bullish here. And puts means that you believe the stock value will go down over time, right? And so if I click on this bullish long call option, because it's an option, right? I have an option between a call or a put. I can then see the price, what we call the break-even price, right? So the break-even price here is 72.63, and this is what I pay attention to the most. And it has to either make sense or it doesn't make sense. So for example, if I'm buying a call and I believe that the stock value will go up, right? Well, then I have to think about how far will it really go up. So for example, I'll just go ahead and click new tab here, and let's look at the actual share price. Let's go here. Let's click on Uber. Currently, the share price sits at 72.64, right? And if we view how it looks for the past week, it's not a hard bet for us to say that, this stock price is going to go up in value over time, especially based on the last week's chart. It's not a drastic ask for the stock to reach somewhere here, for example. It's not that hard. If we look at it in the past month, even then, it might not be such a hard ask for it to go up in value. Now, could be a little bit risky because the chart is bearish. It could be, but overall, it's not that risky of a bet. So we look here and we say, okay, the value, right, of this share currently sits at 72.63. Well, how far can it really go? Some people might think it might go to 74. Some people might go, to 73. Well, it depends on how safe you want to be. But 72.63 is where it's sitting at, and that's why it says here 72.63. So essentially, we want to bet anything above that currently, right? So if I look at, for example, something like this is a much more risky bet than this. And this is a riskier bet than this. Why is that? Because our break-even price is changing. Look at this, right? So 75.02 means that the price has to break 75.02 for us to even make a profit, right? For us to even break even, right, it has to be at 75.02, but for us to make a profit, it has to go past it, right? So for every penny that we make that gap, right? So we make the gap of income, which allows you to get access to more shares, right? But once again, it's more risky. So if you just bought 500, 600, 1,000 shares of Uber, that wouldn't be nearly as risky as this. Why? Because there's a timeline. So let's kind of look at this. So for example, if I believe that the stock price will break 74, I would click 74 here, and I would click here, this little plus. And then what I'm doing here is I'm kind of betting on the current price of where it's going to sit at, right? And what I would do is I would put in one contract, which means 100 shares, and then I would put in the price of how much I'm willing to pay for it. But more importantly, here is the time in force. So what does that mean? We have good till canceled here, okay? We have good for the day. This is when I want to order it, but we have to also have a date where it expires. Now, if you look here, it's currently set to November 8th, meaning today. Now, that's not really a good idea because for me, I don't know where this thing is going to end up. It could go lower, it could go higher. Who really knows? Some people want a week. A week is 7 days. Not bad, right? Some people like 28 days. Everybody's a little bit different, but you have to essentially look at it and say, okay, how many days do you think it will go up all the way? And so you give yourself a little breathing room, and then next thing you know, you buy the option and you wait for it to do well. And then, of course, your options contract has a value on it. So let's go ahead and take a look at my current one. So my current one here it's negative $200 in profit. So essentially I'm losing money, negative 200, right? And the current value or the current price is at $4.58, which actually makes negative 220, right? And my contract expires in about a month, right? A little bit more than a month. excuse me, 2 months. So January 20th, today is November, not January, sorry, December 20th, today is November 8th. So I have all of the rest of November, which is about 22 days or 23 days. And then I have the next 20 days in December. So you multiply that, that's like 40 something days, right? 48 days, whatever the case may be. So that is the amount of days that it will take, essentially, that I'm betting on for this price to break the break even, which is 74.80. Okay, so I believe that it will break 74.80 within these 40 something days. And this is the value of that current gap, right? And about 10 contracts, which essentially means 1,000 shares. And so if it goes a penny past the break-even price, well, it's a penny times 1,000, which in this case, I'll just tell you how much that is. Let's go ahead and figure that out. I'm not good at decimals here. It's 0.01, not 0.1, but 0.01 times 1,000, which would be right here, $10. So I'd make $10 in profit if it goes a penny past 74.80. Okay, and I can what I could do is simulate my returns, and Robinhood is nice at this as well, is I can kind of look at the current price and figure out, okay, where am I going to earn or lose? So for example, if the price is currently 72.50, right, and this is where it's currently at, my value is somewhere here, which is $220 down. But if I, by scrolling, move the price upward a penny, 2 pennies, 4 pennies, you could see now the price is starting to change, right? So you could see I'm scrolling up, scrolling up, scrolling up, and next thing you know, we're in the profit. So how long is it going to take me to essentially make profit? Let's see here, based on this, let's simulate let's see what our numbers are here. It says Uber break-even price, 74.80. Uber's current price is 72.50. So it'll take me a little bit, but let me see here. Yeah, it'll take me a little bit, but we're getting past there. It'll take some time, but it will do well. All right, so hopefully this video helps out. Thank you for watching. Hope it helps. All right, I'll talk to you later. Thanks for watching, and see you soon. Peace out. Bye.